All right, hello everyone. So we're going to talk about the merger and acquisition of Grubhub and Just Eat Takeaway. My name is Travis.
This is Marc.
This is Alberto.
And so in June of 2020, JustEatTakeaway.com announced a $7.8 billion merger with Grubhub. This occurred subsequent to several additional mergers in the food delivery sector, and the combined companies may seek to lower operating costs and continue the recent increases in revenue. The business models of both companies support independent restaurants while providing technology and delivery solutions. Investments in these initiatives, as well as administrative acquisition and other operating costs, have presented challenges for each company. Overall, the merger may lead to decreased costs and improved revenues. And as you see here, the initial merger of Just Eat and Takeaway.com, now with the merger for Grubhub, JustEatTakeaway.com commissions from restaurants comprised of 90% of revenues during 2019, while online payment services and additional revenues from merchandise and a placement totaled more than 45 million euros. Cost of sales increased considerably due to new products and acquisitions, as well as administrative and supporting costs. And just a little quote here to get some relativity. Uber, quote from Uber, like ride sharing, the food delivery industry will need to consolidation in order to reach its full potential for customers and restaurants. So you can see how there's a little uniqueness and a little bit of similarities there. The acquisition strategy prior to the merger with Takeaway, Grubhub had several acquisitions as part of a strategy to expand the marketplace for food delivery. This supports independent restaurants through increased volume of the takeaway orders while improving customer satisfaction and service. Important adjustments to ratios involve the 2017 decrease in the current ratios due to the increase in debt from acquisitions. The debt to equity did not change considerably because the balancing of shares acquired, with additional debt. Now moving on to the acquirers' profitability ratios in our takeaway profitability table here, you'll see that net income for Takeaway went negative in 2017. And as sales decreased in 2019 and profit margins were more negative than 25%. The efficiency of assets declined overall as investments and mergers increased the overall level of assets without a similar increase in sales. The net losses after 2016 were close to the balances of total assets and equity, and this kept returns as a percentage of equity and assets close to the average of about negative 3%. Now we have our target profitability ratios. The ratios of Grubhub, the target could be explained with the increases of operating expenses occurring as faster rate of than return. Expenses occurred at a faster rate than revenue. The bolded percentages indicated an increase of expenses greater than the increase of revenue. This explains how profit margins as well as to-return ratios decreased despite an increase of assets. The increases in revenues led to an overall increase in the asset turnover ratio, as described in our tables here. And moving forward, Marc will take us through a timeline of the merger.
Right now, negative retained earnings along with low values of current assets for Takeaway are better understood considering investments in delivery and technology, as well as recent acquisitions. The Scuba initiative provides delivery services for independent restaurants. This is similar to the carrier services of Grubhub and Uber Eats. Takeaway.com had delivery staff in 91 cities during 2019. This involved considerable operating expenses as well as investments of current assets. In 2019, this also included the merger with Delivery Hero as well as Just Eat, while the merger with Grubhub is set to complete during the initial quarter of 2021. Many of the prior acquisitions for Grubhub involved purchases of all outstanding equity shares. A few of the low-cap acquisitions involved purchases of outstanding assets and liabilities as well as membership units. Each of the merging companies experienced recent shocks to revenue. The merger could add an important source of revenue for Takeaway.com while reducing operating expenses for the long term. Revenue for the current year increased with more delivery. Mergers from prior years affected the balance sheet of each company, while investments in delivery initiatives also decreased current assets. Goodwill and other intangible assets account for most of each company's current assets, while operating costs have led to net losses. Concerning Grubhub, goodwill and retained earnings each had considerable increases from 2016 through 2018, with a slight decrease in 19. Accounts payable followed a similar trend with more than a threefold increase in 2018, followed with only a slight gain in 2019. The acquisition of liabilities through mergers considerably affected the balance sheet of the acquirer, while similar increases in retained earnings balances impacted additional debt. Notice the slight decrease in goodwill for 2019. The Form 10-K for that year noted that no impairment to goodwill was necessary for any year from 17 through 19, although future expectations concerning the fair value of net assets could deteriorate due to market conditions. The 10-K report for Grubhub was noted to be registered with the SEC near the end of February 2020, as this may not have completely considered the subsequent market events beginning in March 2020. Further impairment of goodwill might be expected for the current year if the fair market value decreases below carrying value. Also notice the considerable level of additional paid-in capital as a percentage of total assets. Retained earnings was about 3 times less than paid-in capital. This suggests that Grubhub's IPO in April of 2014, as well as public offerings of other companies that were acquired, such as E24 and Tap and Go, were issued well in excess of the par value of shares. This composition of shareholders' equity suggests that the sale of equity in excess of par value makes up a considerable part of Grubhub's financing. Long-term debt was acquired through acquisitions, and this balances the issuance of equity as demonstrated in the ratio analysis. The acquiring company allocates goodwill in accordance with IFRS to 4 different regional business divisions called cash-generating units. Each of the units have projected revenue growth of more than 10% over 5 years. Completed in 2019 was Takeaway's acquisition of Delivery Hero for a total consideration amount of more than 1.2 billion euros. Consideration was mostly equity, with the remaining balance in cash. 2019 operating expenses for the target were about 487 million in US dollars. Revenue during the same year was more than 415 million US dollars, and the data table shows what rates of increase in revenue combined with what decrease for total operating expenses would be required to continue significant gains from operations. And going forward, Alberto will explain the impacts for Takeaway.com and the acquirer's financial condition.
Okay, we can start considering the short-term consequences and the long-term upside of the M&A. In terms of short-term consequences, the post-acquisition, both companies are set to stay independent, operating in different geographies. This lack of geographical overlap between the two firms means that the marketing efficiency gain from consolidation are likely limited in the short run. Furthermore, the high level of competition in the US food industry could be possible hard to overcome because the US market is known to be highly competitive, normally requiring high spending to gain new customers. This could explain why the stock market price of Jet dropped 13% after the market know that the two companies they were talking about merge. The long-term upside is related to the fact that the food delivery market is growing at a rapid pace and is expected to be more than double in terms of revenues by 2025. Grubhub is currently the largest player in North America, with about 30% of the market shares, like Jet is covering 83% of the shares in the market. So this transition results in a company built around four of the world's largest profit pool in food deliveries: US, UK, Netherlands, and Germany. This market has shown substantial further opportunities for growth, significant penetration, upside, and long-term profitability improvement. And in the next slide, we can see what's the situation financially of the two companies combined. So the two companies, starting from Grubhub, that he has about nearly 300,000 restaurants, over 400,000 US cities. And the portfolio let Grubhub having about 23 million active customers, with GT ending with 48 million. So the combined company will have up to 71 million active customers, with a potential of almost 600 million orders per year, with the GMV that is about 15 billion. And the combined revenue is going to reach up to $3 billion. The adjusted EBITDA, it will be 450. In this slide, we can see that GAT was able to acquire Grubhub for almost $8 billion. That means it's paying 40,000 adjusted EBITDA. And the EBITDA on the revenues is pretty much stable, combining the two companies stays at 15%. In this business is now a really great performance, means that they have a lot to do to improve the profitability. In the next slide, we can see what has been anticipated by my colleague Travis and Marc in all the M&A that Grubhub and Jet did over the years. So in terms of revenues, both of them, they almost triple in 4 years the volume of revenues. They about to increase 1.8 times the number of orders. They increase between 2 and 2.5 up to 2.5 the number of users, and also the network of the restaurant increase up to 5 times for Grubhub. And all of this achievement is mainly made through activity of M&A rather than the real growth of the business. In the next slide, we have our conclusion. So overall, not only these two firms believes to be a good cultural fit, but they also have few of the companies in the food delivery business that they have constantly positive EBITDA, means is good in terms of profitability. And the acquisition will lead to create one of the largest food delivery companies outside of China, connecting various restaurants across 25 countries, even if for now Grubhub he will take a lead on the US market and just take away. He will keep working and mainly focus on the European market and North America and in the part of Canada. So at the end, the merge, it will let Grubhub at least consolidate its position according to the Statista prediction to keep 30% of the market shares, and just it will enjoy it. Thanks for the attention.
Thank you. Any questions?